thebesttraders.com, and plenty of testimonials to back it up. I believe our next speaker is my trading warrior brother, Peter Goodburn.
How's that?
There you are, Peter. You're live, man.
Good.
Looking good. All right, buddy. Take it away, bro.
Woo! Okay, no stress, okay?
Yeah.
Well, I thought, yeah, it is an end game scenario. And first of all, before I kick off, just again, thanks for inviting me today, because it's really quite special. I've been watching some of the speakers yesterday. I thought it was a great presentation from everybody, and I just want to thank you, Dale, for inviting me, Steve, and the gang.
Our pleasure.
It's really great, and a lot of great subjects coming up. So I hope I can sort of titillate you a little bit further before you all sort of break off for the day. But this presentation, which I've put together, is really just to go through what we've seen post-coronavirus. And my impression, just to summarize, really, is that the overall declines that we saw in the major indices, the sell-off, the coronavirus sell-off, basically was a de facto low. It was a correction which, for many indices, actually started back in the January 18 high. That was certainly relevant for the S&P 500. And for some of the European indices, the correction actually began in April 2015, like Eurostoxx 50 benchmarks and things like that. But I can say, from an Elliott wave perspective, one of the most amazing things about all of this is the fact that we have seen a very good confluence of signals all coming at that March low. So that third week of March was a de facto low. And I've put together really some slides today to show you exactly how those work. I mean, of course, I'll try and simplify it, because not everybody's interested in Elliott wave or is a practitioner, but I'll try and make it as simple as possible, because I think overall, if you get what I'm going to tell you today, you'll be able to sleep at night resting assured that the markets are going to sort of trade into new record highs before we get the pop, which is the inflation pop bubble being burst. So, well, let's begin. This is a risk disclosure. You don't want to see that. So this is the aftermath of the coronavirus sell-off. Now, just a bit of track record before we get into this, just to show you that from an Elliott perspective, you can actually forecast well ahead of time. But it takes a little bit of ingenuity to try and figure out what patterns are potentially viable going forward. Not all patterns are easily identifiable. There could be some extraneous events which cause distortion sometimes, and therefore that's why you often find people that are practicing Elliott wave coming up with maybe one or more two different counts. But basically, you can narrow down the field if you do a lot of cross-correlation with indices like we do, and you can also work with cycles to get some idea of timing. Now, this is an old track record which I've had for yonks, which, for anybody who doesn't know the lingo, is a long time. But on the left-hand side over here, you can see a forecast for the Dow Jones Index, which dates back to January 26, 2004. And we were hypothesizing, after seeing all the 9/11 fiasco and then a major low in October 2002, how the Dow was developing to the upside. Now, there was a probability that we could have developed a straightforward five-wave advance and started off the final sequence of advances in the secular bull uptrend that goes back to the Great Depression lows. But in this scenario, we said, hey, there's going to be something more complex going on. Let's look at that scenario. And we forecast this pattern, which is actually called an expanding flat. It's a 3-3-5 sequence. Wave A was the actual decline from the dot-com peak down into the October 2002 low. So that was 71.97 on the Dow. And then we run up in three waves. In this case, we've defined a zigzag to 14,169. And then a huge five-wave collapse down to 64.11. Now, those numbers aren't arbitrary. We've used fit price ratios, and this is something which I've developed over the last 25 or more years to try and augment Elliott wave so that we have something to aim for, which is, of course, a very important strategy. If you're ever taking anything tradable, whether it's short-term, intraday, a 60-minute chart or whatever, or something where you're planning a pension fund or for your 401k, whatever it is, you need to understand what to aim for. And so from this in mind, we've used fib price ratios in a very particular technique. Here, what I've done is, in order to augment where wave B of this pattern finishes at 14,169, I've extended wave A, that's the vertical decline from 2000 to 2002 by 38%. So everybody knows Fibonacci ratios, that's a 38% ratio. So that produced the 14,169 number. And then basically I've extended to the downside the same measurement, but or the same amplitude decline for wave A, but by 23% to get to 6411. And here you can see the results. We got to 14,198. So we got within 30 Dow points at the top, and then 64.70 down to the low. And that was pretty special at the time. So we can actually go forward in time with a certain degree of certainty and plot our course with certain eventualities. Now, there's been a lot talked about recently about a 90-year cycle, but in fact, I think we can stretch that to 94 years, and this is a generic 94-year cycle which goes back to the 1760 period, and you can see the cycle tops. Now, of course, normally you would ideally in a cycle like this, you would like 5 or 6 repeating cycles, but because this is so long term, we just don't have the data. It doesn't exist basically. We're going back to the 1700s, but that's about it. But here you can see that we've got 2 cycle appearances at 1835 and 1929. And if we just roll that forward, we get 2023. And I think that's our target date for the end game for the inflation pot peak. Now, if we go to this chart, this is a track record from December 2017. We were preparing this chart for our annual 2018 report for stock indices, and it depicts the S&P 500 moving up from the 2009 low in this 5-way sequence. Now, we've labeled it in intermediate degree, 1, 2, 1, 2, 3 up here. Now, we were saying at the time that wave 3 was coming into a completion and that wave 4 would actually trade down to about 2170. It would sort of rest upon this minor third wave high within the larger third. It'd stop around that sort of area. And then, of course, it would range trade, consuming time. It was important to consume time in this case because wave 2 was a very simple correction. Here we needed to expand more time. And then eventually it would result in a final push up to our eventual target. So how did it work out? Well, remember the 2170 number. And here we have, of course, our recent low, our coronavirus low at 2196. So we got within 20 S&P points, making that forecast ahead of time. The only difference was that the triangle pattern, which is a sort of a default picture for a complex pattern in wave 4, turned out to be an expanding flat. And an expanding flat pattern looks something like this. This is a typical expanding flat. You come down in 3 waves and you go up in 3 like this into a zigzag, and then eventually you come down into a 5-way pattern. You can see I've added a couple of fib price ratios in there. So that's what an expanding flat pattern looks like, and that's what's happened here. And the target that we have into 2023 is around 4,400, just a shade below. If we work with some of the monthly charts, we can even go a little bit higher. But generally, it's minimum 4,400 to new record highs. Now, we can that, I should say, was derived by extending wave 1 by 1618. So that's a generic fib price ratio that we've tried and tested over the years, and it works. This is the weekly composite cycle, and the intervals are about 7 intervals to make up this. But you can see that the peak coming in for intermediate wave 3, it was a little bit early, and then it drops down here into the March lows. And here's the movement up, Jan, Feb. It's towards the end of 2023, early 24, that particular cycle, that's a weekly cycle, comes into fruition. So we've got a fairly good idea of where price is going. We've got a pretty good idea where the cycles are giving us the time indication for that too. Now, this is a track record of of March 23rd, because we sent our subscribers at the time a buy signal on the S&P saying that the last sequence of that expanding flat pattern had finished at 21, around that 2174 level. And we had the measurement at 2151, and we could see that this downswing on the Monday, that it was a Monday morning, was a bullish divergence, because actually we'd already given a buy signal in the Euroland stocks the Thursday before. So they actually bottomed a couple of trading days before the S&P. But this is just a track record, and you can actually see this on Twitter at the time that we posted this buy signal, that the end of the coronavirus, I think it was that title, that it had completed a major low for intermediate wave 4. And this is another composite cycle. It's a daily. And interestingly enough, we're topping out at the moment on the S&P. We had a reversal signature today, and we've sent out to all our subscribers a sell signal today on the S&P. But the reason is that this data I took about a week ago, but it's subsequently traded up to 29.65. And you can see late April, early May, the cycle turns down for a bit before it starts turning up. So that's another indication that we should have a bit of aggression in the short term. And this is what the S&P looks like with the expanding flat. So we've got 3 down, 3 waves up, and a 5 wave down. And interestingly enough, for those who are familiar with fib price ratios, if you extend this upswing to 29.54 by 61.8, hey presto, you get a target of 34.05, which was just, well, basically, 12 points away from the actual high. It's a fingernail difference, basically. So you're on high alert for a reversal signature.
What told you the market was breaking down, Peter? I remember last time we were on, I don't think we were talking about this type of sell-off manifesting. What was it that tipped you off to the potential of it going back down towards 2,200?
Well, I tell you what tipped us off, this break here. See this low here?
Yeah, 3,200?
Yeah, it was, I'm not sure, yeah, exactly. And
Okay.
that was definitely breaking the uptrend as soon as it broke below that. And we sent out an alert that day it broke saying, okay, we're isolating 3 waves up now. This is not basically a perpetuating bull market already from this low. And it's completely broken down because we measured this number and we said, okay, a break below that really changes the dynamics of this.
Did the speed and the magnitude surprise you at all?
Yeah, oh yeah, absolutely. I mean, look,
Okay.
it just crashed, and we actually picked up the first 5-wave sequence down here. You can see at 28.55. And we sent our subscribers saying, well, it's 5 waves down. We've got another 5-wave picture coming down. We didn't know at the time whether it would end up as a triangle, which means that if you extended that by 61.8, you would have had initial targets about 2,500.
Okay.
But it crashed down, and then we could extend this number, this downswing, by 38%. And that's where we suddenly realized what was happening, that it was an expanding flat pattern. And that's when we posted the low eventually on March 23rd. It has been a remarkable scenario. Now, I have to say that if you're studying Elliott wave, you wouldn't just look at something like the S&P and come up with a conclusion like this. You'd be checking across various indices. And I think it's very important to say that you've got to try and attempt to look at various. It's no good looking at this with the comparison to the Dow, because the correlations are too high and the patterns are going to be almost identical. What you're looking for is something that's generically a different pattern altogether, but is resulting in the same signal. We get a lot of questions about Mbi Technology recently because of what's going on with the coronavirus, and Gilead Technologies trying to produce a serum for that. And there's a lot of companies in the race to find the right coronavirus serum. But this basic chart of Mbi Technology, this is code symbol Mbi. And what it's done is it's generally an incomplete 5-wave pattern from the financial, well, not from the financial crisis lows. Actually, you go back here, which is rather like the NASDAQ 100 index, because that bottomed in 2002. It didn't start its secular bull uptrend, the NASDAQ 100, from the financial crisis lows. That was a second wave correction, the same as here. And so we're missing a 5th wave. But over the last few years, in fact, the last 5 years, since the end of 2015, this biotechnology index has been underperforming. And it's
Yes.
been a real dog, and but it's suddenly coming alive. And it's in a fifth wave. And we've got a target at 97.50, which is huge if you consider, I took this, when was it, a week ago, at 3,900. So we've got huge upside potential in this. If that's going to perpetuate things, then the crowd are going to be on the hunt for this coronavirus serum, perhaps. And maybe that's a good driver that's going to come through. This next chart is I'm sorry, I'm talking very fast because
That's
I've got
okay.
quite a few charts to show you. So if you want to jump in, don't
Go ahead.
excuse me. But
Doing fine.
This Mbi Technology Index, this is a spread between Mbi and the S&P. And we've had this running for quite some years because of our clients watching whether the performance would eventually come back. And we could identify a 5-wave pattern from here. And this was a third wave, for those that know the Elliott wave lingo. And this was a corrective 4th wave correction. And we could see that we were going to continue the uptrend, which means that the spread is going to widen. But that also means that NBI biotechnology is going to outperform the S&P. So if you imagine that if you fixed the two and MBI is going up, the spread is naturally going to widen. So this is really great. And it's actually been widening since September. When we had the coronavirus sell-off, the NBI index dropped as well. So directionally, it was still positively correlated to the S&P, but it didn't drop as much. It actually widened the spread somewhat during that time. So this is a great affirmation that the secular bull uptrend is still intact. So if you hear anybody saying, look, there's going to be a major collapse, the $4 trillion that the US government and the Fed and the Treasury are putting in to try and prop up the economy, that's going to be a disaster down the road. We're going to see a collapse. Still the rallies on the S&P at the moment because we're going to collapse below the March lows. No way is that going to happen. I'm absolutely convinced it's not going to happen. We're instead going to start seeing a major secular bull uptrend. Now, we come to something which I said about earlier about cross-correlation and verification. This is the Eurostoxx 50 index traded in Europe. This is our major benchmark. From the financial crisis lows, we've had this amazing zigzag pattern going up to the 2015 high. It was April where it was trading at 38.36. And the coronavirus sell-off, which you see here, is again another expanding flat pattern.
Yeah, went nowhere all those years.
Sorry?
Now it's time for outperformance?
Well, I think it will outperform.
Is that because I know you're also thinking the dollar has peaked? Could that be part of the equation?
Well, it's an interesting thought, isn't it? Because we're going to look at the dollar in a moment and all the currencies. Okay. And but I'm going to
stop interrupting you.
No, I like it because I think it's very relevant what you're putting in there. I think it will outperform. But the main essence of this is that the coronavirus sell-off created the final C leg down, which is the third and final sequence of an expanding flat pattern.
Okay.
And it's unequivocally telling us that we've got a new uptrend developing. And I would bring everybody's attention to this upswing from the December 18 low. Whereas the S&P moved up in a zigzag from that, we know now that that did complete into the high that we saw just below 3,400 in February. This also developed into a zigzag A, B, C in the same manner. And we can measure this 100%, wave A to B and add that to C. And we come just about short of that target. And we nudged slightly above the old high, which is the qualification for an expanding flat. And then we can extend wave A here by 38%. And that would have come out at 23.28. And we got to 23.02. I think that's pretty good going considering where we are now. So this is really very, very important indeed, and why I think that the inflation pop, or at least the secular bull uptrend for stock markets is still undergoing. Now, we come to something completely different again, but giving the same signal. This is Deutsche Bank. Well, you've probably heard a number of times over the years how Deutsche Bank has struggled. It's basically closing down its investment bank activities in the US. It's completely withdrawn.
BK, yeah.
I mean, you've heard of all of that story. But look at this chart. This is amazing. We go back to this high. Now, don't forget, 2007 is the pre-financial crisis highs. That's when a lot of commodities also topped out. And it's dropped down into a beautiful ABC zigzag, A down, B up, and C. And how do we verify that? Well, first of all, the devil is in the detail. First of all, we must have 5 waves in wave A, and we must have 5 waves in wave C. Wave A, financial crisis decline, down to 1370. We extend that by 61.8%. Here's the fire symbol. And we get to a target of 388, 389. And we're almost there. And I believe that we bottomed out. Actually, this was taken on April 10th. And I noticed that yesterday it produced its quarterly earnings and the share price has gone straight back up. So we're getting nice reversal signatures for this pattern. Now, if there was going to be a secular bear downtrend and the markets were going to collapse below the March lows, as I know consensus analysts is still saying, then you wouldn't get this triggering a major buy signal here. This is going to be a multi-year rally, which will be a percentage retracement of this. I've got 50% retracement going up to something like 21. Wow. So it's going to basically, from the low, it's going to do, its big percentage is still going to triple, quadruple. So this is really big news. And now we come to Deutsche Bank, which is the blue chart, and we come to platinum. And the amazing thing about this is they look very similar, don't they?
They do. Steve, Volgi, platinum.
Oh, I mean, really interesting stuff. Okay.
Yeah, and from a fundamental perspective as well, Peter, platinum is extremely oversold, and even from a fundamental perspective, I think expecting a recovery there makes sense.
You think so? Yeah. I follow platinum a lot, and I'm in touch with a couple of PhD professors who talked about platinum versus stock market and the fact that historically platinum versus gold, you would only see a major peak in the stock market when platinum has peaked above gold, not the opposite way around as it is now. So this is interesting. I mean, two ounces of platinum to 1 ounce of gold. What's going on? This is crazy. So we're going to take a look at some commodities briefly. This is platinum. And you can see that, again, like Deutsche Bank, it's a beautiful zigzag. We have wave A down, B up. And if we take 100% correlative ratio, so measure this vertical down, subtract from here. By the way, this is a log scale chart. Very important to do that. Otherwise, you're not going to meet these calculations. Then you can get a target at 610, which we had at the beginning of January. Never thought we would drop down in so quick a pace. But of course, it's correlated with the stock market. That's one of the key issues here. So we're getting a really amazing synchronization of stock market declines plus platinum also as a fringe commodity bottoming out in perfect timing to Deutsche Bank. So that's giving us another big signal. And if this is simply a 50% retracement from 2304 down, we're going to make 1360 to 1400 over the next couple of years or more. That's great. Now, here's platinum. And what's it look like with silver? Whoa, that looks similar. Well, they're both industrial metals. Yeah, that's really great. So we link Deutsche Bank to platinum, platinum to silver. Let's look at the next chart. This is silver. What's going on there? Well, we've got a big buy signal at the March lows when the stock market's bottomed at 1164. Silver bottomed. And why can we be assured that silver's bottomed there? Well, if we go back to this high here, this is the high that we saw in July-August 16 at 2078. And that decline encompasses initial downswing, a triangle pattern, and then another downswing here, which is a zigzag. The triangle pattern is really important from an Elliott perspective because it confirms that this downswing is a zigzag. And then a 3 price swing event up into September last year to 1966 is an X wave within a double pattern. And the secondary zigzag then dropped down into this low. And if we use, again, fib price ratios in the same exact way, repeating over and over and over again, we extend wave A, which is this movement here, by 38%. We get exactly 1164 on the button. Amazing. And since then, we've noticed that the upswing to current levels is a 5-wave pattern to confirm that the bigger uptrend is still valid. So over the next few years, we're going to get silver going to 22 to 25 bucks, depending on how much we extend wave A up to the top side. Now that's significant. And it also gives us a bearing on what gold's going to do in terms of its amplitude as well. Now, this is gold GDX. And I really love the mining stocks on gold because I think they offer huge multiple returns, much more than, say, gold bullion would do. I mean, we can see that platinum's hit a low. And at some stage, platinum is going to outperform gold. And admittedly, yes, gold is always going to attract. But I would be a buyer of gold mining stocks over gold bullion. And probably I would be a buyer of platinum stocks over gold mining stocks as well. But this gold miner, GDX, we had documented this chart in 2015 as an expanding flat pattern. You come down in wave A, B up, you extend that by 14.58%, you get this high, and then you come down in 5 waves. And in 2016, we were going online to a lot of webinars saying, watch out for around the $12 mark on the GDX, because once we get down there, it's finishing this pattern that dates back to 2008, and there's going to be a massive advance into new record highs. And we got it. Here in 2016, we saw this big swing up. This is labeled wave 1, or perhaps wave A at 31.79. That's the high in 2016. And then here's the flat pattern again, 3 down, 3 up, 5 down, perfect low. And the only amazing thing about this, which did really amaze me, was that we got down to this 1618 low for GDX.
On the crash.
And then, yeah, it crashed and then did a V-shaped recovery, didn't it? I mean,
yeah,
I never caught that. I was waiting to buy this thing and I never got in.
It was hard to react that day. I was interviewing someone who said he liked it. I said, well, why don't you buy it? It's, $16, and he bought it.
If you've got the time, pick up the phone or press the button to do it. I was busy with clients, so I sometimes have to sacrifice trades in order to look after them. But
so we get a little pullback here, Peter, and then we're in 3 of 3 to the upside, huh?
Well, I think it's done. I took this screenshot about a week ago. I think it's traded up a little bit. I suspect it's going to have a pullback at some point. So I don't think too much. Don't be greedy, because this thing is strong. You can see the way the V-shape's recovery. But if you got back down, if it pulled back down $5, buy it, and don't leverage too much. You don't need to. I can tell you that if we go to the next screen here, this is my favorite mining stock. It always has been. Now, the same expanding flat pattern that I just showed you from 2008 is this sequence down here. Look, this is the expanding flat. It's a correction to the preceding advance from 2000. This is going to do 5 waves to 166. You've got to buy it. Wow. Even on an unleveraged basis. It's mind-blowing. You've got to do that. So
triple from here.
And don't be greedy. Don't over leverage, is my say to everybody at home, trading, because you don't need to leverage. This is huge still multiple gains. I mean, I wish we could have, brought down when it flipped down that time. But Newmont Mining, you can see, didn't actually break 2906 here. Whereas if I go back to the, this is the equivalent low here. We didn't break that low. But so it's outperforming even the GDX. So this is going to be, but 166 doesn't look so unrealistic when we were back in.
You made that call down there, Peter. I remember it.
Yeah, it was, really, you've got to do that. So this is gold bullion. This is my preferential bullish count. A lot of Elliottians I know are talking about this upswing being a zigzag, but I think if it had been a zigzag, it would have already turned down in a bigger way from slightly below this number. If we extend the initial upswing to 1375 by 61.8%, we would have hit something like about 1628. And you might say $100 on this chart is not too much of a break, but I can tell you these numbers are really important, especially when you're using the golden ratio. And if you're not familiar with using it as much, convert your charts first of all to log scale and start experimenting with the golden ratio. Extend certain things by 61.8 or multiples 1618 and see what numbers you get. Historically, go back and test things. If anybody's not done that, it's going to be a eureka moment for you. Please do it, because it's a life-changing event. Once you see it, you can't be it's impossible not to be humbled by some of the numbers that come up. But anyway, the main point to this is that the fact that we've broken above 1628, I think probably lends towards the idea that we will break new highs. And furthermore, I mean, look, if GDX is going to make new highs, so is gold bullion. It's not going to stand by. And don't forget, silver has a very succinct pattern that's going to take us up to 22.5, 25 bucks anyway. And it might start to narrow the gap, the gold-silver ratio gap. I mean, record highs. I think I heard you yesterday, Dale, say that, gold-silver ratio has gone to new record highs. I had to look at it again this morning, just in case someone gave me a question on it. But I tell you, it's very difficult to predict what's going to happen there. But apart from saying the obvious, which at some point, silver will catch up and probably start to narrow the spread.
Thank you.
I'm running out of time, and I think, how much time have I got?
You could go over a little bit here, Peter. Go ahead.
Okay. This is oil. This is a very long-term chart going back to the Great Depression lows. I think where we've hit 650, which is, of course, a major low. This has gone back to wave 4 preceding, but it's setting a range. But I think what's going to happen is over the next few years, because of the inflation pop scenario, we're going to probably end up at $61, somewhere up here. I'm going to speed up a bit. I've got a couple of charts on interest rates, that's all. This is the long-term 60-year cycle on corporate AAA bond yields. Goes back to the 1700s. It's a generic 60-year cycle, but you have to give some tolerance, maybe up to 3 to 4 years, sometimes 5. But generally speaking, it's a pretty good indicator of the major peaks and troughs. So you can see the major peak here back in 1981, which was our last inflation pop peak. Yeah, I think you traded that as well, Dale, in those days.
Yes, I was only 40 then.
Oh, God, really? Only 40? Wow.
Yeah, I was in my prime then. Yeah.
Yeah, God, 7 kids and 40 years old. Anyway, okay. This is overshoot. This is basically bottomed out in July 16. We're well past that point. But you can see that the effect is basically up. This is the 10-year generic yields. Labeled the whole decline from 1981 as a zigzag down to 38 basis points. There's zero chance of breaking below that anymore. And the upswing that I'm basically prescribing is this big movement up to 6.5%. And I think we're going to have a credit crunch, which will probably occur somewhere in wave C here, which will basically, be at the time when the inflation pop, we get to our upside targets on the S&P and all of these biotechs, and we'll probably sort of have a new high on gold and all that stuff. And
Peter, if I may ask, how does a credit crunch in a very indebted economy like the US economy, an explosion of yields higher, because with current data and what's happening today, 5 or 6% yields is huge, and gold appreciating can go along with
a bullish stock market.
A bullish stock market, with the only exception being extremely high inflation, not just a pickup in inflation.
Disintermediation.
Well, my thoughts on this are that generally speaking, if the economy is ticking along nicely, you tend to get tightening, right? I mean,
sorry, say again. If the economy is ticking,
if the economy is ticking along nicely and starting to recover, we should start seeing at some later date, not immediately, but some later date, the Fed should start tightening again. Okay.
I'm waiting for that day.
Well,
my beard has grown, white, and I'm still waiting for central banks to become hawkish.
Well, what are the fundamentalist guys going to say to explain the first wave up in yield, say to 2%? What are they going to say is behind it? Economic growth is stabilizing?
Growth stabilizing. Yeah,
growth,
that's the story.
Okay.
Yeah, I think so.
All
this
right.
is the next chart I want to show you. This is the tips. This is the break-even 10-year. And this is a perfect, what I call inflation pop pattern. It's a zigzag from the financial crisis low. So we go back here. This looks like copper prices, and it looks like the MSCI Emerging Market Index and various other things. You can template them over, and they all look the same. But it's a very typical zigzag. We've got wave A, and you can see that inflation started to pick up after the financial crisis collapse. So as growth started to come back, monetary accommodation was there from the central banks. We developed 5 waves up, hit this number in 2011. 2011 was when the commodities all started to pull back, if you remember. Silver peaked, gold peaked, we saw copper peak, copper, aluminium, lead, zinc, nickel, tin, all of those base metals peaked. And they all bottomed in 2016. This one has overrun into a double zigzag correction down into the coronavirus. And look, if we extend this downwards by 61.8 or 38% rather, we get into that low that we saw in March, and it's starting to squeeze up. So this tells us the worst is over. We've now got a 5-wave pattern up, and I think we'll get to 4.25% on this.
Okay.
I think we'll get to 4.25.
Yeah, I'm pretty contrarian. I've been fighting everyone with this narrative.
Do you think
not
that's
thinking,
possible,
a lot of
Dale?
people talking zero rates right now on the 10-year.
No.
Yeah,
No, that's not going to happen.
Okay.
I don't believe it anyway. I don't think that's.
Yeah, I don't either.
There's too many things here pointing the other way around. Let's okay. Now our sponsors asked us to do currencies, so I'm going to zip through the currencies. This is the dollar index going back to 1660. Oh, okay.
Holy cow! I was just a kid.
You were just a bambino in 1660, Dale. I mean, you only had one kid at that time.
You know what? Peter's had this chart since I've known him on the Dixie.
Well,
all right, for a while he's been calling for this.
Well, I mean, the thing is that a lot of people probably haven't seen this chart, so I wanted to bring it up today because
it's a great one.
It's a great one. I think the most important point here is the American Civil War, going back to this is 1865, 64.5, and there's a generic 5-wave impulse pattern after that. 1, 2, 3. There's a nice 5-wave subdivision in wave 3. You wouldn't think that you could even document that during World War I, World War II. This is really crazy stuff. But then eventually, if we measure waves 1 to 3 and multiply that by 61.8, then we can see that exactly measures the 5th wave to its terminal point. Now, this is the quarterly closing at 149.46. Of course, intraday, we got up to 160 something. But from a quarterly closing, which these measurements are based upon, it was exactly right, which is remarkable when you go back to sort of 150 years of data or 200 years of data. Quite remarkable. Now, we're engaged in a 3-wave correction. A down, B up, and C is derived by extending wave A by 61.8%. So we get to about 50, let's say. This is the cycle, which is attributed to the dollar index. Basically, it's a 15.6-year cycle. So we go up and down in what we call central translation, which means that there's an interval of that 15.6 years by 7.8 years. And if we go up and down in successive amounts, you can see that we're trending down for the dollar index to about 2023, 24. Well, that's a very interesting date, isn't it? Because
that's where the stock market peaks out. So a lot of these gains are going to be nominal and inflationary.
Right? Which comes back to the tips as well. So this is why I call it the inflation pop. It's the second phase. The first phase of the inflation pop was after the financial crisis lows. And this is the second phase that's triggering in now. So we're going to see, And of course, if you're familiar with Gann, and one of Gann's numbers was 42, we're about 42 years after the late 70s inflation pop. Interesting. Yeah. This is the dollar index.
My win button out. Yeah.
Sorry?
Oh, my win button from the 70s. Whip inflation now.
Right.
Yeah.
If we overlay an Elliott count onto the dollar index, then that zigzag wave A down here produces 49.35. And we've been really sort of generically running up and down here for a little while, but this is burning time. I think we're about to collapse down on this thing. And I think give it another month or two, this will be substantially lower. And yeah, this is the short-term picture. And you can see how from 2018 we've rallied in a zigzag to that coronavirus peak, 102.99, and we've been gradually working our way down. I think I've got I didn't put a daily in that. I'll show you the euro. This is the euro. Yeah, this is a 16-year cycle. It's not 15.6, slightly longer, stretched slightly longer, but not too much. You can see the bottom in 2017, which was this low here, I'm pointing to now. And the next cycle peak is 2025. And here's the overlay, the Elliott wave overlay, 202. Now, I heard quite a few people saying, oh, the euro should be trading below parity to the dollar and maybe even lower. Never going to happen. Not going to happen. Why?
$2 euro.
This is euro dollar, yeah. Because this is basically bottomed at 103.41 already in early 2018. The cycle's already turning up. And if we go to this chart, you can see we've been in a 2-year regression, a zigzag, A, B, C. Here's the coronavirus sell-off to 106.35. And we're still lumping around the bottom. But I have to tell you, I've sold all my dollars. I've held them pretty well for the last 2 years, but I've sold everything out last week. And I wouldn't be long dollars in this environment at the moment. And here's the short-term daily chart, which we put in our bi-weekly reports. And this goes out to subscribers twice a week. It's part of our currency segment in the report. And you can see that we developed downwards from this high in late March into 3 waves. It's actually a double zigzag pattern for those that are familiar with Elliott wave. And this is starting to trend up. I think in the very short term, I think in last night's report that I published, I expected the euro to pull back a tiny squeeze bit, but other than that, it's trending up. This is sterling dollar, and the coronavirus sell-off produced a low at 114.09, but the outlook now over the next decade is very bullish indeed. This coronavirus sell-off to 114 has finished a huge expanding flat pattern from 201. I wonder how many times longer I'm going to say expanding flat pattern during this presentation. You can see I'm mentioning it quite a lot because it's such a repeating pattern. But anyway, this is the outlook for sterling dollar, and this is the short-term picture. Again, this goes out on our bi-weekly reports, and I'm expecting a little twist down, but then starting to really trend up again and continue its trend against the dollar. This is dollar yen, tricky this one, and I'm very sympathetic for anybody that says it could drop down to 90.30 immediately rather than going up to 21.80 first. The only thing that I was watching very carefully during the coronavirus sell-off was that it was positively correlated to the stock market. So when we got that drop to 101.18, here it is here, that was when the stock market bottomed, and since then it's trended up like the stock market. So I'm beginning I have got alternate bearish counts if we broke below 101.18, but my bias is towards the upside, because I think if we're going to trend up for stock markets, this will probably mean that people will liquidate safe haven yen, and even though the dollar's going to collapse, the yen will be a weaker currency because the stock market's going up. But I could be wrong about that, but that's my preferential count. So that's a bit of a question mark, that one. Aussie dollar, no question that it's going to trend up. Very conservative target to 83.60.
Yeah.
This has completed a 5 pricing event down from 2011, and we're going through a simple correction. So 61.8 seems to be an obvious one. Wouldn't surprise me if we did a lot more to the upside on that one. And here is the short-term counts, which again featured in bi-weekly reports. Looking for a little bit of a twist down there before we go up, as you can see on the inset chart. But that's dependent on really finding resistance around here. I think we've hit that number today. And if it's correlated to the stock market and that drops down a little bit, I think I'm looking for a 9% downswing on the S&P to about 26.38. Then maybe this can drop down. Let's see. This is dollar Canada. You notice that I'm emphasizing some of the commodities currencies. This is, as you know, somewhat loosely correlated to oil. When the oil price collapsed, this one shot up to 146.69, but interestingly enough, it didn't take out this high at 146.91, and it's subsequently trending down. I think this is going to collapse, obviously. That means the US dollar collapsing down and the Canadian dollar appreciating against. And that is consistent with a rising oil price. And here's the short-term Canadian dollar. You can see that this upswing up here is measured to its completion. It came a little bit short. We could have allowed it to 47.5, but I think this is enough. And you can see the dollar index is dropping down as well. So this is ready to start accelerating down the CAD. And this is dollar Brazil. Now, of course, we heard that Lula's been released and then rearrested, the previous president. And Bolsonaro is now firing his judicial judge. And everybody's gone crazy about the economy, and it's weakened the real. But I had this target to fire 72. It's a fifth wave measurement, 61.8 proportion of 1 to 3. And it's hit that so far, and it's reacted down from around that number. So do watch that if you're interested in Brazil. I have to say that I haven't got an updated chart for the Brazilian Bovespa. There just wasn't enough time to put everything in. But that's looking really bullish. And maybe if you do have access to Brazil, you could maybe buy some Brazilian stocks that look good. And you'll also get an appreciating currency. Sooner or later, this will start to appreciate against the dollar as well. So you'll get a double whammy there. And this is Norwegian Kroner against the dollar. 5-wave pattern from 2008 finishing up here. I was looking to see if it could stretch a bit above the coronavirus high, but it hasn't. And it's subsequently dropped like the Canadian dollar. So this is heading down as well in a big way. And then you can take a look at the Russian ruble. Interestingly enough, the ruble has not broken above this old high here back in 2015. And it completed 5 waves down. I was thinking to myself, oh my God, look at this crazy ruble depreciation. The dollar's pushing up during the coronavirus sell-off. I thought, wow, could it actually break that 86 number? But it didn't. It stalled at 82 and it's dropped down since, and it looks like this. So I'm pretty convinced that that's topped out. And we can extend this by 61.8. Here's the golden fire ratio number. And it produced an exact high there, an exact high. Really quite remarkable stuff. So this is definitely going to decline. So that means dollar weakness, Russian ruble appreciation. So I think that's my last chart, actually. Yeah.
Okay, so great. Peter, what a great presentation on crystal meth.
Peter,
I've never seen Peter move this fast. So anyway,
Peter, I'm afraid
ahead,
you're my confirmation bias. A few weeks ago, I gave my favorite trades for long-term FX. 2 of them was long NOK and long rubles against US dollar. So you're my confirmation bias. I'm 100% with you. And what I like, I mean, Peter has a meticulous, obviously he's an expert in Elliott waves, but if you know fundamentals, the way he analyzed markets, everything makes sense with each other.
It's like a jigsaw puzzle.
Yeah, the puzzle is coming together, and I'm 100% with you. Probably I should stop following you because you make me feel even more confident in my thesis.
That's dangerous. So Peter, the people could follow, go to your website and check you out and take a subscription.
Thanks, Dale. Yeah, I mean, if anybody would like to subscribe to our bi-weekly reports, by the way, it's $39. I mean, if you can't afford that, you shouldn't be trading in the first place. But anyway, we try and make it as competitive as possible. I'll just pull up our website. This is the front page of wavetrack.com. And if you want to subscribe to the Elliott Wave Compass Report, just go to here to subscription and click on subscription. And here's the Elliott Wave Compass Report. And you can subscribe there. Just go to add card and you can put in multiple time periods for whatever, 1 month. You can subscribe, and we don't actually enforce you to sign up for an automatic renewal. I mean, we really do trust that if you want to and like what you see, you can basically just let subscriptions expire. And we're even willing, if you don't like it whatsoever and it doesn't fit your time frame, then you can always contact my team at WaveTrack. And the services at wavetrack.com and get a refund. So I'm quite happy to do that. So there's really a win-win game here. If you can, then please do. We'd like to welcome you.
There are no refunds for this 2-day summit. You know why?
I don't blame you.
You know why?
Why is that?
It's free.
Yeah, of
Oh,
course.
no refunds here.
That's
so Peter,
right.
thank you,
But Dale, I have to tell you, oil traded into negative territory last week.
Very true.
Thank you, Peter.
Thank you, Peter. It was wonderful.
What a great presentation.
Thanks,
Appreciate
guys.
it.
Thanks a lot. I appreciate it. It's a great event, and good luck to all of you.
Same
Thank
to
you so
you.
much.
Looking
Peter.
forward
Everyone,
to
that's
having
Peter
you.
Goodburn, and you could follow him at Elliott Wave Track.
Thank you, Peter.
Peter, thank you very much.